Welcome to You and Your Money. Today's episode features Lawrence Hale, Principal Managing Partner and Chief Investment Officer at WHZ Strategic Wealth Advisors.
The Tax Cuts and Jobs Act of 2017 made significant changes to both individual and business taxes, but many provisions are temporary. So what's the big picture that our listeners need to understand about that?
Well, the key thing to understand is that we're approaching a significant transition point in tax policy. So without legislative action, several major tax benefits that Americans have grown accustomed to over the past few years could change dramatically at the end of the year. So this isn't just about tax rates. It affects everything from how families file their taxes to how businesses handle depreciation.
All right, let me break this down and how this could affect different groups of our listeners. First, what about families and individual taxpayers? What changes should they be watching for?
So, Wayne, let me give you a practical example. So consider a married couple filing jointly. Under current rules, they have a standard deduction of about $30,725. If these provisions do expire, that would drop to $16,525. So that's a difference of more than $14,000 in deductible income.
That's a significant change. Now, how would that affect their actual tax bill?
Yeah, let's talk dollars and cents. So we're using some real numbers. For a family earning $100,000 annually, that difference in standard deductions could mean paying taxes on an additional $14,200 of income. So at a 22% tax rate, that's about $3,124 more they'd be paying in taxes.
What about the child tax credit? That's something many of our listeners rely on.
Yeah, the child tax credit's a perfect example of how these changes could affect family budgets. And currently, families receive a $2,000 credit per child under 17. So if this provision does expire, that drops to $1,000 per child. And for a family with 3 children, that's a $3,000 difference in their tax bill. And remember, this is a credit, not a deduction. So that's a dollar-for-dollar reduction in what they owe in taxes.
Let's talk about homeowners. I understand there are several changes that could affect them.
Yeah, and this is particularly relevant for our listeners here in Connecticut. So currently, homeowners are limited to deducting $10,000 in state and local taxes, also known as the SALT deduction. The government loves acronyms. That cap could expire, which could be significant for homeowners in high-tax states like Connecticut.
How significant are we talking?
Well, again, here it can be useful to use a concrete example. So consider a homeowner in our area paying $12,000 in property taxes and $8,000 in state income tax. So currently, they can only deduct $10,000 of that $20,000 total. If the cap expires, they could potentially deduct the full amount. So that's a $10,000 increase in deductions.
What about mortgage interest deductions?
Well, the mortgage interest deduction limit could increase from $750,000 to $1 million in property value. And in our current housing market, that difference matters more than ever. We're seeing many more homes in our area crossing that $750,000 threshold.
What about the focus on business owners? What do they need to know?
Well, Wayne, business owners face several significant challenges, and the most immediate concern is the expiration of the 20% deduction for qualified pass-through income. And this affects sole proprietorships, partnerships, and S corporations. So let me give you an example of what this means in real dollars. So say you're a business owner with $200,000 in qualified business income. So currently you can deduct 20% of that, or $40,000. And if this provision does expire, you lose that deduction entirely. And at a 24% tax rate, that's $9,600 more in taxes.
What about equipment purchases and depreciation?
Well, the bonus depreciation provision is being phased out by 2027. Currently, businesses can deduct 100% of certain capital investments immediately. And this has been a huge benefit for business owners looking to invest in their companies. And the phase-out will significantly change how businesses approach things like major capital purchases.
Lawrence, do these changes affect retirement strategies?
This is crucial because tax rates affect both how much people can save for retirement and how much they should plan for their withdrawals. If the top marginal bracket returns to 39.6% from the current 37%, that changes the math on things like Roth conversions, retirement withdrawal strategies, and even basic retirement contributions.
So what steps should people be taking now to prepare for these changes?
The first thing I recommend everyone do is make a tax projection for 2026, assuming that these changes do take effect. This gives you, really a baseline for planning. And second, consider accelerating certain tax strategies while current rates are in effect. So, for example, if you're considering a Roth conversion in 2025, you should make sure that you consider this might be the year to do a little bit more if you think future taxes are going up. And for business owners, you might want to accelerate major equipment purchases to take advantage of current depreciation rules. And for families, look at your current deductions and credits and plan on how these changes might affect your monthly budget.
From your standpoint, do you anticipate an extension of this Tax Cuts and Job Act? We've talked about this morning. It's set to expire this year. Is it necessarily going to expire?
That is the million-dollar question. I should probably say a multi-billion-dollar question for the government and all of us consumers and taxpayers. It's been signaled that it would be extended. You look at the current administration and Congress, and you do have Republican leadership across the board. Tax cuts are one of their mainstays, and the extension is likely one of their main priorities. If it will go into be extended or made permanent, we think is likely but not given. And will it actually be made permanent in its entirety, or will only portions of it be made permanent? So there's a lot of questions in the air. The most important thing in our mind is to plan and understand if changes do occur, how do you respond, and what actions may you need to take as an individual or a family or a business owner to make sure you're in the best position.
So there's a lot to consider there, and I guess the key is to start planning now and don't wait for this to happen down the road.
Absolutely. If you're thinking about this on December 15th, it's probably too late. So don't wait until these changes are imminent. This is complex stuff with some pretty significant financial implications. So we strongly encourage everyone to work with qualified professionals who can help evaluate how these changes might affect their specific situation. And at WHZ, we help our clients navigate these types of changes as part of our comprehensive planning process.
For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit WHZwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Marrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. WHZ Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.